dream of retirement often comes down to one thing: stable income with minimal stress. And for investors who don't want to actively trade stocks, choose the latest trends, or consistently rebalance your portfolio, dividend ETFs provide a compelling solution. And so in this video, we're going to focus on funds that have that NAV stability, consistent distributions, and broad diversification. So the first ETF on our list is going to be SPYI, the NEOS S&P 500 high income ETF. This one has about a 11 to 12% dividend yield paid out monthly, which is completely okay if you make your budgets around monthly expenses. We can see it's up about 3.47% all time. Very stable NAV, and this is based off of the S&P 500, the top 500 companies in the United States. And we can see during times of market drops, it does recover quite nicely, which is not common for a lot of higher yield income ETFs, especially those from YMAX. I like this ETF a lot. It does pay out 12%, which is going to be about 1% every single month. Pretty respectable, and it does have that diversification that a lot of people are looking for. And if we take a look at NEOS's fund website, we can see it's actively managed. You are going to have that higher expense ratio of about 0.868%, which is pretty high for an ETF, but it's not as high as some of the other actively managed ETFs, which can be about 1% or even higher. So we can also see that it's going to have that call option strategy, as well as taking advantage of tax loss harvesting opportunities that they can utilize with Section 1256 contracts. And this is going to mean that it's going to be tax favorable, especially for people who are lazy, retired, they don't want to pay as much in taxes. Those distributions, any capital gains or losses, are going to be subject to 60% long-term capital gains and only 40% short-term gains. So you're going to have a more favorable tax treatment with this fund. And this is going to be the same deal with QQQI, which is going to be the same strategy: call options, holding the underlyings of the NASDAQ 100, and then selling call options on the NASDAQ 100 is going to give you that monthly distributions of about 14% in the case for QQQI, because it is going to be a little bit more volatile, being the NASDAQ 100, a lot more tech heavy stocks. So you are going to have a little bit more volatility with this ETF, a little bit bigger swings and drops during market downturns. But overall, it should recover nicely when the market does rebound, because you are holding the underlying of these ETFs, and it's not completely capping your upside potential with at-the-money covered calls like a lot of other ETFs. And on the topic of NEOS ETFs, they also have a pretty underrated one in my opinion, the NEOS Real Estate High Income ETF, IYRI, a little bit hard to pronunciate. We can see it does have monthly distributions. We have to go to their website to see what exactly they are in terms of distribution rate. It's going to be about 11%, so a little bit lower than SPYI and QQQI, but for a real estate ETF, this is going to be on the higher end for 11% distributed every single month. And we can see all time it's pretty flat, it's pretty stable, and it's done fairly well since its inception, which it was just released January of 2025. But NEOS has released some amazing ETFs. They also have BTCI, which is a great Bitcoin ETF, pays about 30% distributions, stable NAV. And this is the main reason a lot of people are flocking towards ETFs such as NEOS, which is going to give you that stability as well as higher dividend yields. And of course, for our next ETF, we have SCHD, Schwab US Dividend Equity ETF, which is one of the tried and true dividend players in this space. We can see all time since inception 2011, it is up 231% on share price alone. That's not counting any of the dividends that you're getting. And a lot of people have not been too happy with SCHD as of lately, mainly because it has a low dividend yield, as well as paying out quarterly, which is not the favorable payout frequency as of lately. A lot of people love those weekly distributions. Monthly is okay, but a lot of people love weeklies. And while it's paying around under 4%, paying out quarterly, a lot of people have sold this ETF lately. And especially since the past 4 years, the stock price has not really appreciated too much. So a total return has been pretty equivalent to if you just held cash in a money market account or a high yield savings. But that's not really the point of this ETF. Over time, it should appreciate, and we can see this is really an unusual time for SCHD, where it's really stagnated and remained flat for quite a while. So we can definitely see in the future, especially if they do another annual reconstitution, rebalancing of the portfolio, we can probably see some of these underlying shares inside this ETF do really well as the dividend growth year over year, which SCHD is known for, to do a great, see some growth potential in the future. And we also want to note that SCHD is going to be more tax efficient than a lot of other funds out there. It's going to be qualified dividends taxed at the lower long-term capital gains rates. So that's going to be quite a good thing if you're holding SCHD in a taxable brokerage account, which in my opinion is probably one of the better accounts. I know a Roth IRA, you're going to get tax-free on everything, but for early retirement or retirees, it doesn't really matter too much, and you're planning on using these dividends to pay off expenses. Remember, we're lazy retired investors here, and we want as little tax drag as possible to fund our lifestyles. The best thing about this ETF is you're not really going to lose much money, especially in market downturns. A very defensive ETF, which is a very good thing to have in your portfolio. You don't want a ton of volatility. You want diversification in your portfolio. SCHD is going to give you those defensive holdings that a lot of these other high yield income ETFs are not providing. As we can see at their holdings, we have companies like Chevron, ConocoPhillips, PepsiCo, Altria Group, AbbVie. We also have Home Depot. So these are huge companies, very defensive companies, and they're not really as volatile as, say, the NASDAQ 100 index, which is mainly tech focused. Now, of course, in our portfolio, we do need some higher distributions. And what better way to have high distributions than YMAX? Now, I choose YMAX over any of the other ones because you're getting that diversification. You're getting all of their option income ETFs. I'm not a huge fan of those single stock ticker ETFs. There's just too much risk because if that one underlying ends up tanking, that whole ETF is going to tank with it. So with this ETF, you're going to have about 45 holdings, all of their single stock ETFs inside of this ETF. So if one of these funds do end up performing badly, it's not a big deal because you have diversification with other stocks. Now, if you're looking at the chart, it looks pretty ugly. It's down 36% since inception on share price, but because this is a YieldMax ETF, it has a very high distribution rate, and we have to consider the total return. Now, if we use totalrealreturns.com and compare it to the S&P 500 index, we can actually see it has a total return very similar to SPYI. It's up 38% with distributions reinvested compared to SPYI, which is 39%. And we can see in this chart there are periods and times where YMAX has actually outperformed the S&P 500 index. It really just depends on the market conditions. Sometimes YMAX is going to outperform, sometimes SPYI is going to outperform. But if you're looking for that income, YMAX is going to be a pretty respectable ETF. And I'm a huge fan of it because of that diversification, as we mentioned earlier. Now, next we have Roundhill S&P 500 0 days to expiry covered call strategy ETF, XDTE. This one is a weekly payer as well. We forgot to mention that YMAX is a weekly payer. So you're going to get in this portfolio for retirees, you're going to get monthly, weekly, and quarterly payouts from these ETFs. It's going to help balance it out a little bit. This one is a little bit different strategy than the YMAX. It's going to be 0 days to expiry covered calls. So you're not holding any call options overnight. It's just going to expire the same day. So you're not getting as much risk, in my opinion. And if you take a look at the share price, it is down 16%. So a lot of people, of course, are going to get scared of that. But if we head over to totalrealreturns.com, we enter in XDTE. And this is going to be with distributions reinvested. we can see we have 23% since March of 2024, which is going to be comparable to YMAX, and it's just going to slightly underperform S&P 500, which is going to be up 28%. But for an income-focused ETF, you can't look at the share price too much. You have to factor in all these total distributions that you're receiving. And I think this is going to be a great complement to your portfolio, YMAX and XDTE, to get some weekly distributions. And whether you tend to use that for expenses, reinvest a portion of it, or even manually reinvest some of those distributions into some safer ETFs like SCHD or QQQI, that's entirely up to you. Now, some honorable mentions are going to be DIVO, which is the Amplify CWP Enhanced Dividend Income ETF. It's got great share price appreciation, 74% since 2016, which is absolutely amazing. Now, a lot of people are not going to be too happy with this, but it's going to have a 4.60% dividend yield, which is pretty respectable in terms of total return because you're getting that capital appreciation. As we can see, it's just going up and to the right. It's very great. And you're also getting monthly distributions, which I know a lot of you are a fan of. If we take a look at the holdings, we can see some pretty huge companies in here. We have Apple, American Express, Visa, Microsoft. So we're not holding speculative companies. We're holding tried and true companies that are known for increasing their dividends as well as share price. And our last alternative that you can consider is going to be iShares Core Dividend Growth ETF, DGRO, which is going to be a very good ETF that's going to have more capital appreciation than any of the ETFs that we've had on this list, but we're going to have quarterly dividends as well as a low 2% dividend yield. But in order to make up for it, you're going to have great capital appreciation. As we can see, it's up 170% since inception of 2014, which is more than enough that's going to make up for its low dividend yield. And in this one, we're going to be quite diversified with 400 holdings. We, of course, just like DIVO, are going to have some pretty big name companies: Apple, Johnson & Johnson, JP Morgan Chase, Microsoft, Broadcom, ExxonMobil, and so on. And if we use total real returns to find the real returns of these ETFs compared to the S&P 500, we can see that it's pretty much on par with SPYI. DIVO is going to have a year-to-date return of 11%. DGRO going to be 10.29%. And if we take a look at the overall return, it's going to be 174% for DIVO since 2016 of December, and DGRO is going to be 181%. Now, it's not going to outperform the S&P 500, but that's okay because it's going to be more defensive during market downturns, which is something that a lot of people need to understand. If you're early retirement, you don't want big swings in your portfolio. These are going to help balance out that portfolio and have less volatility while providing more consistency. It's a little bit easier when your portfolio is not as volatile to estimate your monthly income and help pay your expenses, make sure everything's on track. So let me know down in the comments, what are your top picks for NAV stability, as well as the best ETFs that you would hold in a retirement portfolio to help you retire earlier.